In 1637, Dutch investors were paying the equivalent of a full year's salary for a single tulip bulb. Not a field of tulips, one bulb. In 2000, companies with no revenue, no profit, and no business plan were valued at billions of dollars simply because the word .com was in their name. In 2008, banks were selling mortgages to people with no income, no job, and no assets, and rating them as the safest investments on earth. Every generation gets exactly one financial bubble, so large it rewrites the rulebook. This generation is living through its own right now, and most people watching this video are sitting inside it without knowing it. Ryan is 31, marketing manager, Denver, Colorado. $78,000 a year. Reasonably informed person, reads the news, follows finance accounts on social media, considers himself fairly to be someone who pays attention to money. In 2021, Ryan bought a house, not because he had been planning to for years, because everyone around him was buying houses immediately, and the ones who waited were getting priced out of neighborhoods they had lived in their whole lives. Ryan paid $485,000 for a 3-bedroom house in a suburb of Denver. The same house had sold for $310,000 in 2019. His mortgage payment, at the interest rates of early 2023 when he finally closed, was $2,900 a month on a $78,000 salary. That is 45% of his gross income, going to one mortgage payment. Ryan is not reckless. Ryan is not ignorant. Ryan made a completely understandable decision during one of the most unusual periods in financial history. But Ryan is now sitting in the middle of something he does not fully understand, and understanding it, even now, is the most important financial thing Ryan can do. This is what Ryan needs to know. Before identifying the bubble, the definition, because most people use the word without understanding what it actually means. A financial bubble has 4 stages. Every single one in history follows the same pattern. Stage 1, displacement. Something changes. A new technology, a new policy, a new opportunity. Prices start rising for a legitimate reason. Stage 2, boom. Early investors make money. Word spreads. More people pile in. Prices rise faster than the underlying fundamentals justify. The story gets bigger than the reality. Stage 3, euphoria. Everyone is buying. Skeptics are mocked. Anyone who questions the price is told they do not understand the new world. Prices disconnect entirely from any rational basis. Stage 4, panic. Something, sometimes a small thing, breaks the confidence. Prices fall. Everyone tries to exit simultaneously. The bubble pops. Here's the question that determines everything. Which stage are we in right now? The most visible bubble, in 2026. The one Ryan is sitting inside. US home prices increased by over 40% between 2020 and 2023. In some markets, Phoenix, Austin, Denver, prices more than doubled. The driver, interest rates cut to near zero during the pandemic, flooding the market with cheap money. Demand surged. Supply could not keep up. Prices exploded. By 2024, the average American home required approximately 43% of median household income just to cover the mortgage payment. The historical average is 25%, not 43% of take-home pay. 43% of gross income. Before tax, in 1980, considered a terrible housing market due to high interest rates. A median home costs approximately 3.5 times the median annual income. In 2024, a median home costs approximately 7 times the median annual income, double the ratio, in one generation. Ryan bought at 7.2 times his annual income. His mortgage payment is 45% of gross income. Is that a bubble? Or a permanent shift in how housing is priced? That is a question nobody can answer with certainty, which is exactly what makes it a bubble. Bubbles are only called bubbles, clearly, after they pop. The second bubble. The one fewer people are talking about, but, arguably, the more structurally dangerous one. In early 2026, the US stock market is trading at a price-to-earnings ratio, the PE ratio of approximately 28 to 30. The PE ratio measures how much investors are paying for every dollar of company earnings. A pay of 28 means investors are paying $28 for every $1 of annual profit a company generates. The historical average PE ratio for the US market is approximately 16. 28 versus 16. The market is priced at nearly double its historical average valuation. The common explanation: interest rates, AI growth potential, the dominance of large technology companies may all be legitimate factors, or they may be the story of Stage 3 euphoria being told to justify Stage 3 prices. Every bubble in history had a convincing story for why this time was different. The Dutch had one. The .com investors had one. The mortgage market in 2008 had one. This time is always different, until it is not. Pattern interrupts. Quick comparison. The last time the market PE ratio was at this level was 1999. The year before the .com crash reduced the Nasdaq by 78% over the following 2 years. That is not a prediction. It is data. and data is the only honest thing in a market full of opinions. The third bubble, the newest, the most debated, and the one that feels most familiar to anyone who remembers 2000. Artificial intelligence is a genuine technological revolution. That part is not in question. What is in question is whether the companies built on top of it are worth what the market is currently paying for them. Between 2022 and 2025, the combined market value of the largest AI-adjacent technology companies increased by approximately $8 trillion. $8 trillion of new market value in 3 years. From companies whose actual revenue growth, impressive as it is, does not mathematically justify $8 trillion in new value by traditional valuation methods. Ryan has money in an index fund, which means Ryan owns a slice of all of these companies, which means Ryan is exposed to AI valuations, whether he chose to be or not. The irony of index fund investing in a bubble, the very thing that protects most investors from picking bad stocks, automatically concentrates them in the most overvalued stocks in the market. Because index funds weight by market capitalization, and in a bubble, the most overvalued companies have the largest market capitalization. Cousin Kevin, meanwhile, has put his entire savings into a single AI company because someone in a YouTube comment section told him it would be the next Microsoft. Kevin has also recently taken out a personal loan to buy more. This is not going to end well for Kevin. Kevin never ends well. Here's the part that actually matters. Because identifying a bubble without knowing what to do about it is just anxiety. With good vocabulary, 3 principles for navigating a potential bubble environment. Principle 1. Do not try to time it. Nobody, not professional fund managers, not economists, not the people who predicted the last crash, can reliably predict when a bubble pops. People who called the 2008 crash correctly mostly called it 3 years early and lost money waiting for it to happen. Staying out of the market because you think a crash is coming is not a strategy. It is a gamble against compound interest, which has a terrible long-term track record. Principle to diversify beyond the obvious. If US stocks are potentially overvalued and US real estate is potentially stretched, the answer is not to sell everything. The answer is to ensure exposure to assets that do not move in lockstep with those markets. International stocks, commodities, bonds, real assets. A diversified portfolio does not perform best in any one environment. It performs adequately in every environment, which is the entire point. Principle 3. Do not add leverage, you cannot survive losing. Ryan's 45% mortgage payment is a fixed obligation. If his income drops, that payment does not. Leverage amplifies gains in good times and amplifies losses in bad times. In a potential bubble environment, the thing that destroys people is not the bubble popping. It is the leverage they took on at the peak that they cannot service when prices fall. Keep leverage manageable. Always. But especially now. Here is what every bubble in history eventually teaches and what every generation has to learn for itself. The bubble is never obvious while you are inside it. The Dutch tulip investors were not idiots. They were rational people responding to a market that had been going up for long enough that up felt permanent. The dot-com investors were not fools. They were responding to a genuine technological revolution, just at prices the technology could not yet justify. The 2008 mortgage buyers were not reckless by the standards of their time. They were doing what everyone around them was doing, in a market that had rewarded that behavior for years. Ryan is not wrong to own a house. Ryan is not wrong to invest in index funds. Ryan is not wrong for making decisions that made sense in the context he was living in. What Ryan can do now, that most people in previous bubbles could not, is understand what environment he is operating in and make decisions accordingly. Not panic, not sell everything, not move to cash and wait for a crash that may come in 6 months or 6 years. Just be aware. Be diversified. Be careful with leverage. And keep investing consistently through whatever comes next. Because that is the other thing every bubble in history eventually proves. The people who kept investing consistently through the pop and did not panic, sell at the bottom, came out the other side, wealthier than when they went in, every time, without exception. So far, Ryan still owns the house, still has the index funds, still earns $78,000 a year. But Ryan understands something now that he did not understand when he signed the mortgage papers. He is operating inside the most unusual financial environment in a generation. One where multiple asset classes are simultaneously priced significantly above their historical averages, where the story justifying those prices is compelling and may be correct. Or maybe stage 3, euphoria, telling itself it is, stage 2, boom. The honest answer is nobody knows which one. What Ryan knows and what you know now is how bubbles work, how they feel from the inside, and what rational behavior looks like when you are living through one. A bubble only looks obvious after it pops. The job while you are inside one is not to predict the pop. It is to make sure that when it comes, and they always come, you are still standing, diversified, Unlevered, consistent, patient? Smash that like button. Subscribe to Learn Finance with Zig. Drop a comment. Do you think we are in a financial bubble right now? I want to see every opinion. I will read every single one. Stay smart. Stay wealthy.